Are delivery robots really the future? Or, are we just buying into maybe a short-term sugar rush? Today, we are examining the incredible polarization around Serve Robotics, ticker SERV. Welcome to De-Risk, a podcast where we provide a no-nonsense analysis of stocks. Our mission today is a deep dive into SRV, and this is based on our research captured this morning, October 10th, 2025, around 7:49 a.m. Eastern Time.
Yeah, and we really have to set the context first. The wider market, well, it's cautiously optimistic, looks like a slightly higher open today, but let's not forget the macro backdrop here. Nearly half of U.S. states seem to be quietly slipping towards recession, and overall consumer confidence, it's weakening. So it's a tough environment, definitely pretty risk-averse for these kinds of capital-intensive growth stocks.
Okay, so given that macro tightness, why are investors suddenly, willing to pile money into a capital-heavy story like Serve Robotics? Well, the answer seems to lie in yesterday's news. Big news. Acted as a huge price catalyst. They announced three major things. Expansion into Chicago with Uber Eats. They rolled out their 1,000th robot. Quite a milestone. And crucially, this strategic multi-year partnership with DoorDash. And the result, the stock just soared. Jumped over 12%, and now you've got 5 out of 6 Wall Street analysts firmly in the buy camp. Bullish.
Right. And that DoorDash deal, that's the strategic pivot point, I think. It does more than just move the stock price. It validates their underlying level 4 autonomy tech, and maybe most importantly, it secures necessary fleet utilization rates. That is the absolute key to eventual profitability in this whole delivery robot business. You need those robots busy.
Okay, so that's the compelling narrative of the story, but now we had to move from that exciting story to the cold, hard financials. Our research highlights this massive gulf, really, between the market's enthusiasm right now and the company's current intrinsic value.
Exactly. While the market is celebrating the story, the current financials are, frankly, deeply in the red. When we run the discounted cash flow models, the stock actually shows a deeply negative intrinsic value.
Negative? Wow.
Yeah. Why? Well, this company needs huge amounts of capital expenditure, CapEx, right, to manufacture, build, and deploy these autonomous fleets globally before they can achieve real scale and, decent unit economics. So investors aren't valuing the company based on today's performance at all. They're making a colossal bet on future profits, basically hoping today's price is a bargain years down the road.
So the company is fundamentally burning cash, just pouring it into building that necessary scale. Yet Wall Street is overwhelmingly bullish. Are they just ignoring the fundamentals? Or do they maybe know something about those long-term unit economics that we might be missing in the current numbers?
Okay, let's pivot then to the speculative side, because this is where it gets really interesting. The intense battle being waged right now between the super aggressive bulls and the hardened bears, the sentiment is incredibly polarized. You look at options traders, they're placing these overwhelmingly bullish bets. The put-to-call ratio, it's tiny, 0.12. Just for context, that means options traders are placing roughly 8 times as many bets that the stock will rise as bets that it will fall. That's extreme confidence, very extreme.
And this is a big counterpoint. Almost a quarter of the available stock, 24% of the float, is currently being shorted.
24%. That's massive. It is huge. And it creates that classic short squeeze scenario. It's like a powder keg, right? Where the bears are trapped if the stock keeps climbing. And technically, you look at the charts, the trend, the volume, the momentum. It's undeniably bullish right now. It confirms there's serious conviction behind the sudden move upwards.
So the question for you, the listener, becomes, do you trust the options traders? They're typically, high-risk gamblers betting on momentum. Or do you bet with the short sellers, who often represent that highly informed, smart money that believes this thing is fundamentally mispriced?
But while that trend looks like a freight train, we absolutely must issue a technical warning here. A key momentum gauge, like the RSI, is now flashing overbought. Think of it like your car's oil light flashing red.
Okay.
The engine's been running too hot, maybe for too long, and the stock is likely due for a sharp, probably short-term pullback. Just needs to catch its breath. And volatility, it's exploded. Which, yes, confirms this is a powerful new trend, but it also means you're going to see massive daily price swings. Big risk there.
Okay, so considering all this, the polarization, the volatility, the story versus the numbers,
right?
What's our final synthesized outlook? We are settling on a cautiously bullish view, at least for the next several trading sessions.
Yeah, cautiously bullish. And if we connect this to the bigger picture, look, the risks are substantial. It's technically exhausted, maybe overbought. The fundamental valuation is abysmal, let's be honest. And that massive short interest, it creates enormous downward pressure if momentum stalls. However, The DoorDash partnership is a game-changing catalyst. The technical picture is overwhelmingly positive right now, and that short squeeze potential, it remains explosive. It seems like the narrative has just overpowered the fundamentals, at least for now.
So what are the key levels to watch?
Right. For the week ahead, the key battleground is that recent high, call it the $17 and $18 zone. That's likely the short covering trigger point, and the critical invalidation level. If it closes back below yesterday's opening price, which was $15.11, below that, the bullish case takes a serious hit.
All right, so the final provocative thought for you to chew on. Will Serve Robotics actually deliver sustained profits down the road? Or is this just a short-term sugar rush, maybe propelled by trapped bears scrambling to cover? For now, it certainly seems the bulls have control of the delivery route. That's all for this deep dive. Remember, this podcast is for informational purposes only and isn't financial advice. Always do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.